Good morning. It's Wednesday, February 22nd. My name's Jeff Cohen. I'm president and investment advisor representative for Chicago Quantum, U.S. Advanced Computing Infrastructures Incorporated. Here to talk today. So, our model has been risk off now since February 8th, I think was the first video we made to talk about it. And I've explained, if you're somebody who listens over and over again, I've explained what that meant, which is the expected return to the market is lower, relatively speaking, than the risk-free rate of return, and that it's changing. So we did a few things yesterday, and I want to share them with you. The title of this series is Forging Your Investing Edge. And really it's that art form where you look for an edge in the stock market, in the bond market, and then you have the courage to act on it, which is what's driving this series. And so you can see the picture with the forge, right, with the hammer, and we're trying to make something on the anvil there. And so that's why we say forge your edge. And so what has been happening? So short-term money, such as a 13-week treasury bill, is up to 4.71% this morning. So 4.7% on your money. And if you want to put your money away for 10 years, you can earn almost 4% now. That's actually nice interest. If you were to go ask a banker, would you take a 4% bond? They'd probably say yes, because they're probably paying 1% for deposits. And so 1% for deposits, 4% for yield, I'm guaranteed 3%, go golfing, right? So that's interesting. But short-term money at 4.7 is a lot. So we're going to take a look and see 1 month treasury is actually, it looks down 4.6%, which is interesting because I don't know why that would be. The 1 year treasury, though, is at 5.125, 5 1/8, and so that's high. That's actually really high. And so I don't normally think of risk-free money as 1 year money because that's a long time to tie up your money. But I got to tell you, right, if a friend came to me and said, or a client came to me and said, Jeff, I got $1 million, I got a year, what do I do? I could tell them to, duck and weave in the stock market, or I could say you could earn 5 1/4, 5 1/8 right now in a U.S. Treasury bill. And we could probably work out a way that you won't pay state and local tax. That's terrific, Jeffrey. That's terrific, right? And you won't charge me? No. I mean, I won't charge you for the treasury bill. I might charge you $50, $100 for the advice and help you buy it. But, wow, that's great. So you're not making any money, Jeff, but I am. Yes. It's risk-free. It's risk-free. It's cost-free. It's beautiful, right? Who doesn't want to earn 5%? And so that's the essence of half of the market being risk off. So, you know me, I like to look at mortgage rates, and you can see that the 30-year fixed mortgage rate is up to 6.9%. That's high. That's high. 6.9%, that's almost 7% mortgage. We're back. The high recently has been 7.4. And so we're up to, so high mortgage rates means less affordability in homes, means selling less furniture, less painting, all that good stuff. So, but where are we in the market? So let's take a look for 5 years. These are the different S&P 500, the Dow, the NASDAQ, the Russell. This is just, it's COI-FIN. I like COI-FIN, right? And so you look and you see, all right, we're up a fair bit from where the market was 5 years ago. We're up a lot less from where the market was 3 years ago. And we're actually down from where the market was 1 year ago. So if you were to say to me, Jeff, how much money am I going to make in the stock market? My expectation is that you're going to go up 7% from where we are now. Yeah, maybe 8. Maybe 8. But I'm counting on 7 plus another 1.6% dividend yield. That would put the S&P 500 just where we were a year ago. Now, I don't have a crystal ball. So is it 10%? Is it 12%? Is it 4%? Is it what? I don't know. But I'm in that 7% range. So maybe it's 0 to 14. 0 to 14 I buy completely, right? So that's not an exciting market right now. That says the S&P 500 maybe rides another wave, right? And it comes up a little. Okay. Yesterday, you see the markets dropped quite a bit. If you want to look at one-day performance at the bottom, you'll see that large cap value, core, and growth were down about 2%. Small cap value, core, and growth were down about 3%. Mid was in the middle. And so, yeah, this is not good, right? This is a tough market. This is another downdraft. Who knows? I can't predict the future, but I can tell you that the market went up a lot in the past month, and it seems to have come all the way back down. And so it's risk off. So I promised you that we would forge our investing edge, but let's take a look. The market opens in 12 minutes. Is there anything to look at? If we look at yesterday, the market just kind of declined throughout the day, and I knew it. By the way, I spent a good part of the morning listening to Vladimir Putin's State of the Nation speech to the Federal Assembly, or their Congress, both houses. And so I didn't really watch the data, moment-to-moment action, but it was negative. I knew it would be negative, right? So here we are. Gas is at $2.42. Again, pretty high. It's been as high as $2.70, but it's pretty high, right? It's been as low as $2. They're saying that the exchanges are going to be up anywhere from an eighth to a quarter. Fine with that. Bonds are up, which means yields are down. I don't know that I believe that, right? I think we're in an interest rate situation here where interest rates are rising. And if we look at this view of the futures, you can see things like silver at 21.85 or 21.84. Gold's up a little, silver's down. Silver down is not helpful, right? Copper down. It's not good for the economy. It says the economy maybe is going to be a little weaker. You can see crude oil down to $76. Now I remember when it was negative, right? Let's go crazy there. My wife and I still talk about it. I wish we would have rented an oil tanker off the coast of New Mexico, or off the coast of Texas. Filled it with 50,000 barrels. Would have been nice, but we didn't do that. So it's tough here, right? The equity exchanges look like they're going up. I don't know that I buy it. And so yesterday there were certain things that we look at, certain proprietary indices. If we looked at the banks were down. Okay, that's never a good sign. We look at high beta stocks down dramatically. Okay, so risk off, risk bad yesterday. Now your low beta, mixed. Low beta, people were rotating into some names. General Mills, I should say. AbbVie, Northrop Grumman. People were Hershey's. People were rotating. Bristol Myers Squibb, Lockheed Martin. So people were rotating into low risk. I told you it was risk off. It was risk off. Negative beta stocks, interestingly enough, they fell with the market. But not all. And like the VIX went up. But now today it looks like the VIX is going down. Chips and semiconductors, right? Normally a hot industry when the market's going up, momentum driver. Boom, all negative. So yesterday was risk off, and in fact behaved risk off. It punished risk. Cannabis and tobacco, I would expect no better. Look at those drops. Risk was definitely off yesterday. So, what did we do? We did some work yesterday, right? A lot of work, actually. And, here, of course, we produced the spreadsheet that has all the stocks with all the data that shows you the stocks that are individually the best. And if you scroll to the bottom, individually the worst. The worst is Carvana, Syncor Pharma, Madrigal Pharma, Upstart Holdings, Pliant Therapeutics. So a lot of biotech, AMC, right? So a lot of really cassava sciences, Snap, Canopy Growth, which I think is just raising more money by selling more stock. Who are your best performers? P&M Resources out of New Mexico, MoneyGram, Berkshire Hathaway, Carl Icahn's business, Royal Bank of Canada, Sun Life, Illinois Toolworks, Pepsi, Coke, Equity, Commonwealth, BCE, which is Canadian telephone company that also does some outsourcing, Johnson & Johnson, Marsh McLennan, Mondelez, Honeywell. So no surprise, low risk at the top, high risk, what I call dog stars at the bottom. All right, so what did you do differently, Jeff? Maybe you could share some insight with us. Share some secret sauce, right? Market's opening in 7 minutes. Maybe we can do it quickly, because I still believe the market is risk off, but a couple more drops, and I'm going to start raising the expected return of the market. So you can see the QQQ is down 17%. This is excluding dividends. IWM is down 9%. The S&P 500 is down 10.5. Variance has not gone up. We've got $1 billion market cap threshold for our model right now, and the minimum volume traded in a given day is $10,000, or I'm sorry, 10,000 shares. It's a $10,000 price limit and a $1 price limit. So we exclude stocks that trade under $1. These are all foreign companies, which is great. If we take a look, so 2,113 stocks passed data validation that traded yesterday. Variance is about the same. Expected return is about 9% on your money if you were to invest in all 2,113 stocks. CQNS power around 3.3 is low. It means low. It means risk off, low power. It means variance is getting closer to expected return. Normally, we fly high with expected return. These are all really important lists of stocks that you should be looking at. So, we're running it. So we did some new things yesterday. So we talked in the video yesterday, and so I made changes, right? Or actually, it was on the weekend. So genetic algorithm FAST gave us a 5.7. Now these are completely different algorithms that are running. And so one of them 37 stocks, one of them 47 stocks with effectively the same answer. Always interesting, right? Because it's a different way to skin the cat. But what happens is we set it up so these are genetic algorithms. So I want you to think about like a virus, right? A virus goes from host to host. Every time it goes to a new host, it has a chance to mutate. We force a mutation here. It's not random. We force a mutation. And if we don't get a mutation, we actually force a mutation. Okay? And what happens is we only let it run 12 generations before we force it to quit if there's no improvement from the mutation. So in this case, it only had to mutate 94 generations or 153 generations, although this one took a long time. It took almost 20 minutes, and you can see what you get, 5.7. Then I said, look, we're not doing this right. We need to start looking maybe big mutations. big mutations. So I did that. I coded in some tremendous mutations that should kill the stocks, kill the virus, right? What's interesting is it stopped at 96 stocks and 56 stocks respectively. It's interesting. So it really didn't do much better, but it gave you a very different answer again. Then 5.7, we have our bespoke simulated annealer, which is terrific. It just does great. I mean, I could just run the simulated annealer and we go home a winner. But I really want to find different types of stock portfolios for you. Then we have our unseated Monte Carlo, which is just a random throw of the dice. We started a 79 stock portfolio, and the best one was at 41 stocks, which is interesting. Then we seed it with high beta, and you can see did best at 21 stocks. And then we ran it through our simulated annealer, and it popped it back up. Then we ran another seeded high beta, which is fine. And then we did low beta. So I had a feeling that low beta stocks might actually be the answer. So for low risk, maybe picking a portfolio that's seeded with a lot of low risk stocks would help. It's not an answer. It's not a quick answer. This is why, as you're out there trying to invest, it's not about only high risk, only low risk. Because I've got that here, right? A lot of high risk, a lot of low risk. It doesn't give you the best answer. You need another way. But we're trying. We built this low beta seeded solver, and it really didn't do better. And we ran it quickly, 269 seconds. We have another low beta that seems to have done a little better, right? And so it's a little random, 21 stocks. But it only got you to 29 versus 57. So it didn't actually win the game. And then we have another low beta. So we're trying. And then we did a portfolio selection based on particle swarm optimization. And what I did was I decided, so I want you to think about a flock of birds. And a flock of birds, they fly together. And every once in a while, one bird sees something, so it moves. But it wants to come back to the herd, to the flock. So at 5,000 iterations of 150 birds flying in formation, with each bird noticing, hey, maybe there's a better portfolio. And they come back, right? So what happens is you don't get that bad of an answer. Look at that, a 2.1. But it was a huge stock portfolio. It was 1,000 stocks. And it took 100 minutes. So then we ran portfolio swarm optimization differently with some different settings. And we actually got a slightly better answer much quicker, 487 seconds. And then we did one that had not as good of an answer, but in 186 seconds. So what happens is that we can run where the birds don't move very far. It's like the birds don't look very far, don't fly very fast, right? They're not as ruthless. So what happens is I can make the birds very ruthless, and they could drive to a solution very quickly, but it appears I lose some value. Now this, to be honest, it's not great. We're not getting the best answer, but it's not bad. It's something. It's different. Now this is a real disappointment for me. We ran the D-Wave simulated annealer, but it took 120 minutes, and it gave us a very good answer, but not even close to the best answer. So the D-Wave simulated annealer really didn't do it. Really took a long time too. And then we ran it again with a different structure. So what we do is we run a full matrix that's loaded on both sides, top and bottom, And then we run a matrix, which is only the top. Just the top gives us a better answer than top and bottom. But they take such a long time. And then we ran our reverse bespoke simulated annealer in reverse. And it didn't do any better. 400 seconds. But I deepened it a lot. And then we ran the genetic algorithm, exhausted, seeded, and it actually did a little better, which is great. Not much better. It's a tiny bit better. Five, 7, 3, 7, 4. 5, 7, 3, 7, 3. So I got like a tiny bit better. But what we did here is I changed it up, and this genetic algorithm, exhaustive seeded, has no mutations. No mutations. So and not just that, no new solutions. So I said, just look at the best answers that you had. Now, I could go deeper, and I might, but it's so interesting. It only found a better answer the first generation it ran, and that was that. And now we go back, and of course you got your positive, negative skewed stocks, which may have something in this market. You have your leptokurtic and platykurtic stocks. Again, may have something to say in this market. And what we're doing now is we're only showing the best 25 portfolios that we found. And what you're going to find is they really vary in size now. Because you're risk off, 50 stocks, 52 stocks, 47 stocks, 45 stocks, and the edges are all right around the same. We found a lot, 37 stocks, a lot of solutions that are all around the same edge, but at anywhere from 37 to 57 stocks. And then actually, I'm going to show this to you. We then changed our... and then we changed the way we think about the stocks. So the best stocks don't all have a huge market cap. I mean, Berkshire Hathaway, right? $667 billion. But PNM Resources only $6 billion. MoneyGram only $1 billion. And so different, right? Different solutions there. Different sizes. But it helps you if you're trying to think about where to put your money. You know the old adage, right? Put your money where everyone else puts their money, right? In high market cap stocks. So, all right, market is open. If you're watching, you're not a day trader. You're not trying to catch that morning edge. But let's see. Is there something at the bottom maybe that helps? So these are all the stocks that split. You're noticing a lot of similar stocks with the one-day spikes. Stocks that fell in price very quickly. Stocks that rose in price very quickly. The number of negative beta stocks has dropped dramatically. We're down to 2 negative beta stocks. We're going to have to update our website with this. And the stocks that have dividends, you have a lot of 5 and 6% dividends, and then you can still earn a nice dividend out there. You can. There's plenty of dividend paying stocks. You just got to be sure you're ready, right? Some of these could have some idiosyncratic risks. A lot of them are in energy or in shipping. You got to be ready for that, right? Because shipping's not doing that well right now. And energy, you saw that oil and gas are down. Gas is down to like $2.50 right now. What's natural gas down to, Jeffrey? Let's take a look. Natural gas. It's trading much higher, I think, because people were worried about Look at how crazy that is. Yeah, natural gas at 2.25, right? So, yeah, that's kind of where it's been for a long time, and that's why your limited partnerships, your gas pipeline companies, are going to struggle because you're producing oil, and a byproduct is natural gas. So do you vent it, or do you capture it? Do you sell it? And my guess is we're drilling for a lot more oil. My understanding from EIA is that there's a lot more oil, right? Where is my oil data? Where's my oil data? Drilling productivity. Oh, I'm so frustrated. Where is it? Short-term energy. This isn't storage. This is I don't want prices. I want data. I want storage. That's okay, but can't find it. But net, pretty weak. You can see it here. I'll show you crude oil, West Texas Intermediate. That's also down. So energy's coming down. We're producing more of it. Coal, I think that's also coming down. I saw coal production. Not really. I mean, it's up from a week ago, but it's up a little bit from a year ago. We're doing okay. We're starting to get more coal. You can see how it ebbs and flows here, right? So I was looking at an interior coal producer, Hallador Energy, and you could see not a lot of coal production in the middle part of the country. It's just really kind of a struggle. It's hard to mine for coal in the Midwest. So I'm not counting on it. So that's where we are. Markets risk off, and we're honing our edge. We're honing our own edge, right? We are looking for edges in the market. We're looking now low beta. We're looking for different ways to solve, different concepts, right? We may even go back to running quantum, but I'm not sure what to run in the quantum computer, because a quantum computer can only take like 118 stocks, at least last time we looked. And which 118? Do I give them the low beta? This is why I'm doing this, by the way. If I take our low beta stocks, you do okay, 0.29. If I give it the high beta stocks, less well, 0.199. If I give it random, maybe I'd do a little better. I don't know. I don't have an answer for you, right? I mean, maybe what I do is I use the D wave, and the only thing I do is I run it in reverse. I run it on a best answer. That's probably the right answer. Now, don't go stealing the idea. But my idea would be, take the D wave. So here's the problem. You can't give it all 2,000 stocks. And when we do a reverse simulated annealer, we have access to all 2,113 stocks, right? So what I want to do is I want to take the D wave. I want to reverse simulate anneal, but I still need to take the best solution, 51 stocks, and add in another 118 minus 51 stocks equals 67 stocks. Add it, and I got to figure out which ones I'm adding. which 67 do I add? Now, I used to do the All-Stars, which was the best CQNS score. We could do high beta. We could do low beta. We could do negative beta. I don't know. Do something. But it's interesting. And so still, at the end of the day, you don't need to run all these, right? Because at the end, the only edge I got, so this is important for you. If you're thinking of building a model like this, you can say, Jeff, you're a big knucklehead, right? Because you ran all these solvers. And then before you actually did the solver on the best solutions, you were at negative 5.737. So you ran a reverse simulated annealer, and you were at the same exact negative 5.737. And then you ran the genetic algorithm, and you were still at negative 5.737. So you didn't do any better. So forget all this stuff. Just run your simulated annealer and walk away a winner. Do the whole thing in like 20 minutes and wrap it up. And we might. But for me, I like having all these other ways to try to find a best answer. It also gives me a sense of where the edge is, right? Is it high beta? Is it low beta? Is it, where's the edge? So, all right, so at the end of the day, here's where we're at. I'm Jeffrey Cohen, and I'm trying to help you find an edge in the market. What I would tell most people is just put your money in a combination of the S&P 500 or the NASDAQ Composite 100 or the Russell 2000 or all three. So you've got a highly diversified set of portfolios, and then take the rest of your money and put it risk-free. Earn your 5%, walk away a winner, right? So you got some money earning risk, you got some money risk-free. Don't touch it, don't trade it, don't manage it minute by minute. What's going to happen is the market's going to go up, and you're going to be like, oh my God, I made all this money, and it's going to come down. And eventually it's going to go up, and it's going to come down. And over time, though, it goes up a lot more than it goes down. And so you would have started investing here at 1,100. Oh, it went down to 900. Oh, I'm losing my shirt. Oh, it went up to 1,500. Oh, it went down to 700. Oh, it went up to 4,500. It doesn't matter. Let it run. You're basically investing in the entire stock market, in the capital stock of the United States. I'm bullish on the United States. Doesn't mean we don't have hiccups. We don't have knucklehead presidents and congresspeople. We don't have wars and pandemics and famines and everything. But over time, market goes up. It does. I don't know whether it's going to go up today, but it goes up. It's fine, right? Wrap it up. Plus have some money in risk-free. And between the two, you're fine, right? And unfortunately, what our model says is there's no get-rich-quick scheme today. Markets are risk-off. And so maybe you should take a little break. Maybe put your money in diversified holdings. Because the only edge we're finding, if I go back to my best answers again, right? First one is 50 stocks for a 5-7 edge. 57 10 to the negative fifth. It's a tiny edge, right? 50 stocks, 52, 47, 51, 46, 37 stocks. So that might be nice, right? You get in there. It doesn't even matter what stocks they are. At some point here, you got so many different portfolios to choose from. You can say, Jeff, I'd like to get this list because I'd like to maybe see, I can work around existing positions I have. I can maybe see if my portfolio is close to one of these, and that way I can kind of manage to it. Yeah, 36 stocks over here, 47 stocks over here. These are big portfolios, highly diversified. And so, yes, some of them have Google, some of them do not have Google. Some of them have Hormel Foods and Johnson & Johnson and Kellogg and McDonald's and Microsoft and Packard and P&M Resources. Lots of stuff, right? So, good luck today in the market. Be careful. We're still risk off. And you can see why, right? I mean, who knows what the market's doing? We're now in a flat consolidating pattern, which is kind of what we're thinking, right? When the market was going up, everyone made money, right? Even when it dropped a little, it still went up because the Fed put the put in place, right? The Fed said, I'm going to print money and get us out of this mess. And now the Fed's tightening. And you really don't want to fight the Fed. You really don't want to fight rising interest rates. Not when they're getting to 5% and when mortgages are getting to 7%. Because here's what's going to happen. They could keep raising interest rates. What is CPI right now? What's inflation? Maybe I don't have all the answers, right? But this is Bureau of Labor Statistics, 12-month change, not fancy, with 6.4% inflation. Food running 10%. Energy running 8.7%. 10 and 9. All items. So something must be cheaper, right? Something. Maybe coffee's cheaper, but they've been having sales at the coffee grounds, at the store. So maybe coffee's cheaper. But in general, food and energy are up. Rent's up. Consumer price index went up 0.5% in January. 0.5 times 12 is 6. Compound it, maybe 6.5. Oh, look, we're at 6.5. So we're running at inflation. We're running monthly and annually way higher than we're supposed to be. So you know they're going to raise interest rates more. It's just going to happen. There's no question. Do you really want to fight the Fed? Or do you want to put your money away in some risk-free assets? So that's where we're at. We keep honing our edge. We keep trying to show people things too. Like the big thing with our portfolio, the big thing that we look at, right, is are there different portfolios, things like negative skew, positive skew, stocks that have gone up, stocks that have gone down, leptokurtic, platykurtic, different levels of beta, different industry sectors. And so what we're able to do is while the market is trading, we can tell you kind of where the action is. But the big picture is we're risk off. Look at coal. You know, who knows? Who knows where we are? But it sure looks mixed. And we're looking in within a 52-week range. Everything's kind of in the middle there. And so, money managers, health of the stock market. Just looking at the 52-week average, sorted by market cap, the ones at the lower end of the range are down, the ones at the higher end of the range are up. So the successful money managers are doing great. People are moving their money to the more successful, the more stable money managers. Morgan Stanley, Charles Schwab, Goldman Sachs, Blackstone, BlackRock, Brookfield Asset Management, UBS. By the way, Brookfield Asset Management needs to be moved down. That's not a large one. If you're Cohen and Company, you're not liking life too much. Or you're Sculptor Capital Management or Virtus Investment Partners. Actually, that one looks pretty good. But B. Riley, trading more to the bottom end of the range. So, and then one we've been looking at, Credit Suisse. Credit Suisse has a real issue. So they have to really fix that. And so there's a couple other stocks that we look at that have issues, and one of them is Credit Suisse. So good luck in the market today. Hope you enjoyed the video. If you liked the video, it would really help us if you hit the subscribe button. We're not paid to make the videos, but if we can get to 1,000 subscribers, I can get a free cup of coffee from Google, from YouTube, and I would love that. It would really be helpful. Plus, it tells me that you enjoy the videos and that you watch them and it's helpful to you. Like, that you want me to keep doing it. You want to be notified that there's a new video, that there's something going on. Drop a comment, maybe share the video. That really helps too. If you drop a comment, I'll answer it. And that's it. Thanks for watching. You take care now. Bye-bye.